Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. Have you ever heard someone say America is almost 39 trillion in debt? You probably heard me say it. Wondered, should we actually be worried? Because depending on who you ask, the government debt is either the biggest threat to the economy or it's simply nothing to panic about. So who do you think is right? Today we're going to separate politics and economics and look at what the numbers actually tell us. So today we're going to break down what government debt is and why countries borrow money, when government debt helps economic growth and when it starts to become a problem, and third, what all of this means for the Federal Reserve, financial markets, and your wallet. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy easy to understand economics, please hit the like button, subscribe, share this video with someone who wants to understand what's really happening in the economy. Now let's dive into the video. So what is government debt? Government debt is simply money the federal government borrows when it spends more than it collects in taxes, okay? Borrowing mainly happens through treasury securities, things like treasury bills, notes, and bonds. Investors, banks, pension funds, and even the Federal Reserve buy these securities because they're generally viewed as among the safest financial assets in the world. As of today, the U.S. gross national debt is approaching 39 trillion, with the Federal Reserve financial accounts showing federal government debt around 34.5 trillion using a different accounting measure. Okay, so that's enormous, and it is. But the more important question isn't just how much debt exists. It's whether the economy can continue supporting it. And that leads us to the next logical question. Why do governments borrow? So governments borrow for many reasons. During recessions, borrow. During natural disasters, they have to borrow. During things like what's going on with Iran, they may have to borrow. Infrastructure projects, simply just because spending exceeds the tax revenue or the tax money that they're able to bring in. So borrowing isn't actually bad all the time. In fact, it can stabilize an economy during downturns by supporting jobs and consumer demand. The challenge comes when borrowing keeps growing faster than the economy for many, many years. Economists often focus on debt relative to GDP because GDP represents the country's income and production. A larger economy can generally support more debt than a smaller economy. So debt itself isn't the issue. The long-term trajectory is. And once debt grows large enough, a cost starts becoming increasingly important. And that is interest. That's basically the cost of money. I've talked about interest and exactly what that is in previous videos. But every borrowed eventually requires interest payments. So if interest rates rise, refinancing older debt becomes more expensive. The Congressional Budget Office projects that net interest costs continue climbing over the next decade because both debt levels and average borrowing costs remain elevated. You just think about it like this. Think about it like a household credit card. That's the easiest way to put it. If your balance grows while interest rates rise, more of your income goes towards paying interest instead of buying new things. Governments, they face a similar kind of dynamic. That doesn't necessarily create an immediate, but it can reduce budget flexibility over a longer period of time, which raises another question. How does all of that affect the Federal Reserve? Quick pause, guys. If you want more breakdowns like this that explain economics without all the confusing jargon, make sure you subscribe to Evanomics 101. New videos break down the biggest stories shaping the economy, markets, and your money. Now we're gonna hop back into it. So the Federal Reserve doesn't directly control government borrowing. Its main job is keeping inflation under control while supporting maximum employment. It has what's called dual mandate. But government debt can influence the environment the federal in. So recent Fed research suggests that higher expected debt levels can place modest upward pressure on longer-term interest rates and treasury term premiums over time. Meanwhile, the Fed has recently held interest rates steady while inflation remains above its 2% goal, creating a balancing act between supporting growth and keeping inflation contained. Markets watch Treasury yields closely because they influence mortgage rates, corporate borrowing costs, and stock valuations. If investors demand higher yields to lend money to the government, borrowing becomes more expensive across much of the economy. Which brings us to the question most people care about. Government debt affects everyday Americans indirectly. Higher interest rates can make mortgages, auto loans, and business financing more expensive. So businesses facing higher borrowing costs, they may decide to invest less. Consumers may delay large-scale purchases. Investors more than likely are going to adjust portfolios as Treasury yields change. And on the other hand, government borrowing can also finance investments in infrastructure, research, and emergency response that support future growth. So the economic impact isn't simply a question of being good or bad. Don't think about it like that. It depends on how the money is used, how fast the economy grows, inflation, the path of future deficits. Recent economic data shows us GDP growing at a modest pace while inflation remains above the Fed's target, reinforcing why policymakers are trying to balance growth, borrowing costs, and price stability. So here's the bottom line. Here's the breakdown. Government debt isn't just a giant on the screen. It affects about everything. It affects interest rates. It affects markets, the federal decisions. It affects business investments. Ultimately, it affects your own financial situation. The important question isn't whether debt exists. We know it does. It's whether the economy can continue growing fast enough to support it while keeping inflation and borrowing costs under control. If you found today's breakdown helpful, please be sure to like, subscribe, and leave a comment below. Do you think America's debt is becoming a serious long-term challenge, or do you still believe 39 trillion is manageable? This is Evanomics 101, your #1 source for everything econ. I look forward to seeing you at the next video. Thank you.